Could a single number significantly influence your investment decision? Would you buy a stock just because its price to earnings ratio or PE ratio looks low, or avoid one just because it seems high? Everywhere you look, including finance channels, apps, and even textbooks, the PE ratio consistently appears as the key metric. It's quick, it's simple, and it looks like a reliable shortcut. But here's the real question. Is the PE ratio actually as helpful as it seems, or is it giving you a false sense of confidence? Today, we're cutting through the hype and diving into what the real data actually says about the PE ratio. What is the reality? It's more complex and more revealing than most investors realize. Welcome to the Deep Beat channel, where we transform complex financial concepts into music and wisdom. We've created a special song all about the PE ratio to help you quickly grasp this essential investing metric.
A high PE means growth in sight. Investors pay now for the future flight. A low PE might show the price is cheap, or doubts about growth run a little deep.
If you haven't seen it yet, be sure to check it out now on our YouTube channel. The PE ratio is straightforward at its core. It's the current market price of a stock divided by its earnings per share, usually calculated using earnings from the trailing 12 months. In practical terms, the PE ratio tells you how much you're paying for $1 of a company's earnings. If a company earns $5 per share and the stock trades at $100, the PE ratio is 20. That means you're effectively paying $20 for every $1 of profit the company generates. That's why the PE ratio is so popular. It's simple, accessible, and easy to calculate. It provides a quick sense of whether a stock seems cheap or expensive, at least on the surface. Generally speaking, low PE indicate undervalued stock, and high PE means overvalued stock. But here's the catch. The PE ratio only becomes meaningful when you compare it in the right context. It's not a verdict, it's a comparison tool. You need to compare a company's PE to others in the same sector, or to its own historical average. But different industries have different norms. So a high PE in sector like technology might be reasonable, while a high PE in another might raise red flags. Still, even with proper comparisons, the PE ratio has serious limitations. Its biggest blind spot is growth. It tells you nothing about a company's future earnings potential. A high PE might be justified if the business is growing rapidly, and a low PE might be a trap if the company is shrinking or facing structural challenges. Because the PE ratio is based on past earnings, it can mislead investors who are focused on future performance. It also ignores other critical aspects of a company's financial health. For example, it tells you nothing about how much debt the company holds or how much cash it generates. Two firms might have identical PE ratios, but one might be heavily in debt and the other is not. So how do smart investors use the PE ratio wisely? Not in isolation. It should be the starting point, not the final judgment. To use it effectively, you need to pair it with other ratios that compensate for its blind spots. One key complement is price to cash flow, which focuses on the company's actual cash generation. Unlike earnings, which can be affected by accounting choices, cash flow is much harder to manipulate. It gives you a clearer picture of how much real money the company brings in. Then there's the debt-to-equity ratio, which helps assess financial risk. It measures how much of the company's financing comes from debt versus shareholder equity. This is critical for evaluating the stability of the business, especially during economic downturns. These ratios work best together. Each one fills in a piece of the puzzle. PE shows you valuation relative to earnings. Price to cash flow shows the underlying strength of the business model. Debt metrics reveal hidden risk. In summary, the PE ratio is a useful tool, but only when used in context and paired with other indicators. It is a helpful first filter, but it cannot stand alone as a basis for investment decisions. It ignores growth, ignores debt, and tells you little about the future. So don't look at a stock's PE in isolation. Ask deeper questions, compare it to peers, examine growth, cash flow, and leverage, And always understand the story behind the numbers. Smart investing isn't about chasing a single magic number. It's about building a multidimensional understanding. The PE ratio is a doorway. Let it open your curiosity. So is the PE ratio helpful? Absolutely. It's a starting point, an introduction to valuation, and a quick way to screen for potential opportunities. But if you stop there, you're not investing, you're guessing. The most successful investors treat the PE as the beginning of a broader investigation. They know that no single number tells the full story. Understanding the complete picture is crucial. This video will give you a few key takeaways to remember. 1. The PE ratio is one of the most popular ways to value a stock, but think of it as a starting point, not the final answer. 2. A PE ratio only becomes useful when you compare it properly, especially against other companies in the same industry or to the company's own past performance. 3. The PE ratio works best when you combine it with other financial metrics, like looking at the company's cash flow and how much debt it carries, to get a clearer picture of its true value and risk. The real question isn't, is this stock's PE low or high? The question is, what factors contribute to this number? And what additional information should I consider before making a decision? So the next time you see a headline shouting about a stock's PE, don't just react. Dig deeper, contextualize, analyze. Smart investing does not involve taking shortcuts. Thanks for spending your time with us. If you're interested in diving deeper into the PE ratio and exploring its real-world applications, we've got a dedicated podcast episode that takes a closer look. You can find it now on our YouTube channel. Don't miss it.